So you want to then, step one is to convert either to a butterfly or long condor. So if you've got a trade that's starting to stall out, go against you, you've got the option of either stopping the trade out, taking your loss, or you've got these two different strategies you could look at. So you want to assess the market based on, again, support, resistance, momentum, Fibonacci levels, whatever you're looking at to kind of determine your exit strategy. What is your line in the sand that triggers something to make you take action? Now, step three is the options for the exit plan. What are you going to do? Are you going to, hold for an expiration? Are you going to hold into maybe a pin into expiration if you set up one of these offsetting spreads to convert to butterfly or condor, which we'll look at? And so once it's inside that spread profit zone, you could take it off. So that's one way to hold it into the expiration once you convert it. If it looks like it could go out at that strike that you're short. Okay, so what would happen then is you're taking advantage of that implied volatility going to zero and time to go to K going to zero. So that's the easiest thing to happen. So if you had it like a call debit spread on, let's say, and the market started to kind of waffle, maybe go down, and so you converted it to a butterfly, then you've got a number of different options. You could just leave it if it looks like the market, let's say you converted it with that $100 short strike like we used earlier. So the market came up, it was trading down at 95 or so, and then it came up to 98, and you converted it because it was going down, but it looks like it's going to maybe go out at 100 at expiration. Well, then that's the perfect situation. You just leave it alone, and if it goes out in between anywhere in that zone or that tent, you're going to salvage that trade and make money. And the same would be the case if you had a condor on. You might just convert it, and then you just leave it alone and see if it closes out inside your profit zone. Okay, so that's the easiest outcome. Or the other outcome is you leg out of the original debit spread. Okay, so you might close out the original debit spread, and then you just leave short the bear call credit spread. So you can just think of all these different options that you have. Let me erase this. So let's say you put on that call debit spread, you converted it to the butterfly, and the market doesn't look good at all. It's still stagnating and drifting lower. Well, then you might just decide close out the debit spread side, take your loss if you can offset it with the credit spread. So then you have left just the bear call credit spread. So let's say you had that on and it cost you $95 was your at risk on the debit spread, and you closed it out and you lost let's say $40. You lost $40 on it, and let's say you had the credit spread side, though, you'd set that up at $60 credit. So then you just take your loss, $40, whatever, leave your credit spread on for 60 if it looks like it's going to expire worthless, and you just actually made $20. So you just kind of look at your position in time to decide what you want to do. Now, if it's too close to call and you don't want to chance making the wrong leg, legging out incorrectly, then just leave it alone, take your medicine, take your loss. But the thing is, you're going to take a lot less loss than you would have if you'd left your original, say, a bear call credit spread on. So if you're just totally unsure, just leave it alone, let it expire, and make sure that any of the end of the money spreads that you have short, you're closed out. But there's a whole section or chapter in here about exercise, so you can go through that. All right, so you can leg out the debit spread and hold the credit spread until the loss is offset, so know what it takes to offset the loss that you were taking, say, on the debit spread. Or the other thing you could do is cover the credit spread. So if it looks like it's going to regain its original direction up, let's say if you had a call debit spread, then you just close out the bear call credit spread side. You might actually have profit in that one, because if the market's kind of churning sideways, you're getting time decay on that. So a lot of times you're going to see that you'll actually maybe even have profit on that credit spread, which then would adjust down the cost of your debit spread. So you may decide to close that out and leave your debit spread on, and you might even have an adjusted lower cost. So then just do that, and stay with the original trade if it looks like it's going to resume in your original direction, and take advantage again if you can have any time decay profit. And this again will be an adjustment or a reduction of your cost of your initial debit spread, making a profit target even easier. So that takes advantage of that time element. So that's the beauty of it, buy yourself some time, but also get paid for that time.